Most of you are sleepwalking into a trap. You think clicking buy on a S&P 500 index fund is a strategy. It isn't. It's a prayer. And in 2026, the markets don't answer prayers. They reward preparation. I've spent 40 years building a fortress by seeing the cracks before they become canyons. Today, those cracks are in your favorite index. If you stay parked in VOO, you're betting on yesterday's news. I'm going to show you where the real money is moving right now. Look, I'm a red-blooded, full-throated believer in the American economy. But being a patriot doesn't mean being a sucker. We have 3% inflation that isn't budging, a massive power grid crisis, and a technological revolution that is about to separate the real businesses from the AI tourists. You need tools that actually work in this environment. Let's talk about 5 specific vehicles that belong in a fortress portfolio for 2026. If you want the full breakdown of these specific tickers and the data behind our 2026 outlook, hit that subscribe button. We're building a fortress here, and you're invited. The core problem with the current market is that blind indexing has become a form of intellectual laziness that ignores the reality of 2026. For decades, the S&P 500 was a reliable engine, but we are now seeing a level of concentration where a handful of names dictate the entire direction of your wealth. When you buy a passive index fund today, you aren't just buying the winners, you are forced to swallow the laggards and the companies burdened by maturing cheap debt that they now have to refinance at much higher rates. An active quality filter is the only way to separate the true compounders from the zombies. We are looking for fortress quality, businesses with high return on invested capital and the ability to pass costs on to the consumer without blinking. In this phase of the AI cycle, the pick and shovel story is over. We want the entities that are actually converting that massive capital expenditure into tangible free cash flow and margin expansion. If a company is spending billions on infrastructure but can't show how that spend translates to the bottom line, an active manager has the mandate to cut them loose, whereas a passive index is stuck holding them all the way down. This is about discipline. It is about looking at a balance sheet and demanding real earnings, not just a compelling narrative. In a world of sticky 3% inflation, you cannot afford to hold mediocrity. You need a concentrated, high-conviction approach that prioritizes durability over broad market participation. The global obsession with generative software has created a massive blind spot regarding the physical reality of the 2026 economy. The power grid is at its breaking point. You cannot run a digital revolution on a mid-century electrical skeleton. Every data center being built to support the AI transition requires an immense constant load of electricity that our current infrastructure simply wasn't designed to handle. This creates a structural deficit that makes electrification the most critical trade of the decade. We are looking at a massive wave of capital expenditure flowing into high voltage transmission, grid-scale storage, and advanced nuclear modular reactors. This isn't just about green energy. It is about industrial resilience and national security. The companies that build the transformers, the copper cabling, and the cooling systems for these massive server farms are the new gatekeepers of growth. While the market chases volatile tech multiples, the real durable value is accruing in the firms that provide the plug. We need to target ETFs that capture the entire value chain of energy independence and grid modernization. These are the old world industries enabling the new world tech, and they possess immense pricing power because their services are non-negotiable. If the power fails, the software is worthless. By focusing on the backbone of electrification, you are moving away from speculative hype and into a foundational asset class that will benefit from a multi-year supercycle of infrastructure spending that is only just beginning to accelerate across the domestic landscape. The Mag 7 and large cap tech have dominated the narrative for so long that the market has fundamentally mispriced the real America found in the small cap value sector. As we move through 2026, the valuation gap between the top-heavy S&P 500 and high-quality smaller enterprises has reached an extreme that historically precedes a massive rotation of capital. We aren't talking about speculative pre-revenue startups. We are talking about established, profitable companies in the Russell 2000 value space, manufacturers, logistics providers, and regional banks that form the industrial backbone of the domestic economy. These firms are the primary beneficiaries of the massive reshoring movement and the modernization of the U.S. supply chain. Unlike the global tech giants, these businesses are highly sensitive to domestic growth and are currently trading at multiples that suggest a recession that simply hasn't arrived. While the broad indices are priced for perfection, small cap value is priced for disaster, creating a significant margin of safety. Furthermore, As the Federal Reserve begins to stabilize the interest rate environment, the pressure on these smaller balance sheets is easing, allowing their superior earnings growth to finally shine through. This is where you find the alpha that the index huggers miss. By shifting focus to these overlooked domestic players, you are moving into assets that have tangible book value and real cash flows, offering a fortress of stability against the volatility of high multiple growth stocks that are increasingly susceptible to every minor shift in market sentiment. The era of free money is over, and in a 2026 environment where the Federal Reserve is maintaining a higher for longer stance to combat sticky inflation, capital appreciation alone is a risky bet. This is where a fortress income strategy through equity premium income ETFs becomes the essential stabilizer for a modern portfolio. These vehicles don't just sit on stocks and hope for a green day. They utilize an active covered call or hedged overlay to generate immediate, tangible cash flow. By selling call options against a basket of high-quality equities, these ETFs effectively convert market volatility into a monthly paycheck. In a sideways or slightly bullish market, which is the hallmark of 2026, this strategy outperforms because you are getting paid to wait while others are sweating over daily price swings. We are targeting a 7 to 9% UI yield that isn't coming from junk debt or distressed assets, but from the inherent fluctuations of the world's best companies. This creates a defensive buffer. The premiums collected from those options act as a partial hedge against downside moves, protecting your principal while ensuring the engine of the portfolio keeps turning. It is about durability and discipline. Instead of speculating on when the next bull run will hit its peak, you are systematically extracting value from the market's uncertainty. This approach ensures that your wealth isn't just a number on a screen that fluctuates with every headline, but a functional cash-producing asset that reinforces your balance sheet regardless of the broader index's direction. The United States remains the cleanest shirt in a very dirty global laundry pile, but in 2026, a fortress portfolio cannot afford to be geographically provincial. We are seeing a profound structural shift where specific international markets are decoupling from the stagnation of Western Europe and the volatility of China. Japan has undergone a quiet but revolutionary transformation in corporate governance, moving from a culture of cash hoarding to one of shareholder returns, buybacks, and efficiency that the market is only beginning to fully price in. Simultaneously, India has emerged as a demographic and industrial powerhouse, fueled by a massive middle-class expansion and a digital infrastructure that is leapfrogging traditional Western systems. These are not speculative emerging markets in the old sense. They are sophisticated, resilient economies providing a critical hedge against domestic U.S. political noise and currency fluctuations. By utilizing targeted ETFs in these regions, you are capturing growth that is driven by internal consumption and regional trade blocs rather than global export dependence. This diversification is about risk mitigation through geographic strength. When the U.S. market faces valuation headwinds, these regional leaders offer a completely different set of drivers: favorable demographics, manufacturing reshoring from China, and a newfound commitment to capital discipline. You are looking for high conviction exposure to the specific nations that have spent the last decade fixing their balance sheets and are now ready to lead the next leg of global expansion while the rest of the world struggles with debt. The strategic necessity of the 2026 market lies in recognizing that the great power competition is no longer just a geopolitical headline. It is the primary driver of industrial capital. We are witnessing a massive multi-year supercycle of domestic reindustrialization that is effectively dismantling 30 years of globalized just-in-time supply chains. This shift toward just-in-case resilience means that the companies building the physical foundations of the North American economy are entering a period of unprecedented pricing power. We are talking about the producers of specialized steel, the manufacturers of high-end industrial automation, and the logistics firms that control the ports and rail lines. These are moated businesses that have become the primary beneficiaries of government-backed reshoring initiatives and a desperate corporate push to move production closer to the end consumer. While the broader market remains fixated on the digital cloud, the real value is accumulating in the firms that own the dirt, the pipes, and the factories. In an era of structural inflation, these tangible assets act as a natural hedge because their replacement costs are skyrocketing, creating an insurmountable barrier to entry for new competitors. Investing in this resilient domestic theme through targeted ETFs allows you to capture the rebuilding of the American industrial base. This is about moving your capital into the essential infrastructure of the next decade, focusing on companies that generate massive free cash flow by solving the world's most urgent supply chain vulnerabilities. The extreme concentration of capital into the largest technology stocks has created a valuation bubble that is beginning to lose its structural integrity in 2026. This isn't just a market correction, it is a fundamental rotation where the Mag 7 are finally being held to the same rigorous earnings standards as the rest of the economy. When these high multiple giants miss even a single growth target, the fallout is catastrophic because they have been priced for a level of perfection that is unsustainable in a high interest rate environment. This creates a massive opportunity for the equal weight and value strategies that have been ignored for nearly a decade. We are looking at ETFs that strip away the heavy weighting of the top 5 names, allowing your portfolio to breathe and capture the growth of the other 495 companies that are actually trading at reasonable multiples. These are the businesses with the pricing power to navigate sticky inflation without destroying their margins. By shifting into these undervalued sectors, you are moving away from a momentum trade that is increasingly fragile and into a valuation trade that has a much higher margin of safety. This is the essence of risk discipline. It is about recognizing when a crowded trade has become a liability and having the conviction to move your capital into the high-quality, cash-generating businesses that the rest of the market has overlooked in its pursuit of the next AI headline. This rotation is the primary driver of alpha in 2026, rewarding those who prioritize fundamental value over popular sentiment. The era of free money is a historical anomaly that has officially been buried by the structural realities of 2026. For a decade, investors were trained to believe that risk was a myth and that the Federal Reserve would always step in to subsidize a market downturn. That safety net is gone, replaced by a fortress balance sheet mandate where liquidity and capital preservation are the only metrics that matter. In this environment, every dollar in your portfolio must be treated as a soldier in a defensive war. We are looking for ETFs that prioritize low leverage, high interest coverage, and a history of dividend growth that isn't funded by debt. This is about survival of the fittest. When the cost of capital stays above 3.5% a guiding, the companies that relied on cheap refinancing to fuel their buybacks are going to hit a wall of reality that will wipe out equity holders. You want to be positioned in the firms that generate enough organic cash to fund their own expansion without begging the bond market for permission. This is the ultimate hedge against a credit crunch. By focusing on quality factor ETFs, you are effectively filtering out the speculative rot and the zombie companies that have haunted the indices for too long. Discipline means saying no to the high multiple dream and yes to the boring, durable, and liquid reality of a cash-rich enterprise. In 2026, the market isn't going to bail you out. Your only protection is the strength of the underlying assets you own and the readiness of your capital to move when the next canyon opens up in the broad market. The bottom line is that the world of 2026 doesn't care about your past successes or your loyalty to a 2010 investment playbook. We are operating in a climate of sticky inflation, high-stakes infrastructure deficits, and a brutal separation between companies that talk about the future and those that actually own the hardware to build it. If you stay parked in the average, you are choosing to inherit the debt and the decay of the laggards alongside the growth of the leaders. A fortress portfolio isn't built on hope. It is built on the cold, hard discipline of active selection, electrification, and geographic resilience. You have to be willing to look past the marquee names of the last decade to find the industrial backbone and the cash flow kings of the next one. This isn't just about picking winners, it's about refusing to own the losers that the big indices are forced to carry. The market is giving you a choice. You can sleepwalk into the next concentration trap, or you can take control of your capital and demand real ROI, real power, and real stability. Fortune doesn't favor the bold anymore. It favors the prepared, the liquid, and the disciplined. Build your fortress now, because when the cracks in the broad market finally become canyons, it will be too late to start digging the foundation.